Again, welcome for everyone for today's webinar. It's on impact investing. We called it Impact Investing 1.0. This is part of the KoSI webinar series. KoSI essentially stands for Competence Center for Social Innovations from the German chapter where we are based from. It's a project that's co-funded by the European Union. And today's webinar, as mentioned, is about impact investing. I want to briefly kind of like give you an overview of what we have planned today, and then we can dive right in. Essentially, 4 main topics. First, I want to give you a little bit of an overview of like what FASE and the KoSI webinar series is about. That shouldn't take more than a few minutes. And then we shall focus on kind of like the main parts of today's webinar, which is, first of all, what is actually social entrepreneurship and impact investing? And then in particular, more of a deep dive into what types of financial instruments can social entrepreneurs actually use? And how does a typical investment process look like? All in all, this webinar should take about 1 hour. I will most likely speak for about probably 30 to 40 minutes, and then we have enough time for a Q&A. If you have any questions already during kind of like this webinar, feel free to just post them in the chat. And then I will try to already pick on them while I'm speaking. And if not, we just put them towards the end of the webinar for the Q&A section. Real brief introduction still from my side. And yes, there's already the first question. Will the slides be available afterwards? Yes, they will be. And as you already noticed, this webinar is also being recorded. So we will try to also put that on the KoSI website so that afterwards, for example, either you or also your friends who might be interested in that kind of topic can rewatch it. My name is Christoph. I am a transaction manager at FASE. Have been working at the intersection of like entrepreneurship, social innovation for meanwhile more than 10 years, and I'm quite glad to be able to like share a little bit of what we discovered and what we work with in our day-to-day work with you today. Essentially, that brings me to like kind of the webinar series. Today, we have the first webinar on impact investing. We have 3 others lined up for the next few weeks. One is measuring and managing social impact in collaboration with Fineo, one of our partners. We have another one in February for investment readiness for social enterprises, where it's really more about like what is actually needed in order to attract investors, impact investors. And then we have the 4th one on scaling impact and systems change with in collaboration with Ashoka. We still have 2 others that we haven't yet announced, which will take place in March and April as well. So I think easiest indeed would be to kind of like follow us on LinkedIn, in particular the KoSI website or also the FASE website on LinkedIn pages, and there you would be updated on all further webinars and topics that will be coming up. So without further ado, maybe a little bit about FASE, what we actually do. FASE, essentially, we are an advisory firm that kind of like builds bridges between social entrepreneurs and investors. So on the one hand, we support social entrepreneurs on the one hand, developing their impact and business models. But then on our main focus is indeed the looking at social enterprises with regard to investment readiness and enhance their investment ready, support them on their way to investment readiness. And then once we are kind of like at that point where we feel like we are confident on approaching investors, we also have our investor network of social impact investors all across Europe that we can like target and approach for specific transactions. That is also kind of like what we then communicate towards our investor network, that based on the work that we do prior with social enterprises, they have then access to a pipeline of like sourced and carefully curated social enterprises that are investment ready. that is essentially what FASE does, and we've been doing that since almost 10 years now. We have so far worked in more than 75 transactions all across Europe, have mobilized more than 50 million euros of capital into social enterprises. And since 2 years also co-initiated an investment fund called European Social Innovation Impact Fund that invests directly into enterprises as well, typically in collaboration with our wider investor network. So if that's of any interest for you, feel free to reach out to me. Happy to have a chat. But today, main focus indeed, not so much about what FASE does, but really more about what we see with regard to impact investing in general and how that can be beneficial for social enterprises. So the webinar I kind of like have structured according to those kind of like 3 main questions. First, why should I actually start a for-profit social enterprise? And the word for-profit is quite an important one here, because we also know that obviously social enterprises can be for-profit or non-profit, but when it comes to getting impact investors on board, typically what they would be looking for would be a for-profit social enterprise. That doesn't mean profit maximizing, but it should at least create revenues and create some sort of a profit. But I'll dive a bit deeper into that aspect first in the first part of the webinar. The second part would be if you then are, for example, interested in raising impact investment from different investor types, then the question would be what type of instrument would be actually needed or would be like relevant for you. I will share about 3 main investment instruments that we see in the market and how they apply for social enterprises. And then we have the third part of the webinar, which would be what type of investors are actually out there and how do they differ from each other. And as a bonus, if we have enough time, which I hope that we do, we will then kind of have an overview of how a typical transaction process actually looks like and what is kind of like needed in a typical transaction process when it comes to raising investment from impact investors. Right, so concept of social entrepreneurship. I'm quite certain that most of you are well familiar with that. So I want to just briefly touch that the way we see it, or the way we see it in the market, it's very often this this like mix between, on the one hand, obviously the business component, on the other hand, the social component. And typically what we used to see in, you know, a few years back or decades back is that it's very much kind of like 2 worlds. There's a non-profit world and there's a for-profit world. And social entrepreneurship essentially combines the 2, where you bring a social cause, you have identify a social problem, but you want to solve it with entrepreneurial means and therefore also potentially create a profit while solving this particular problem. And as I kind of like mentioned before briefly, that is quite an important aspect here, because for-profit essentially means that you can also pay back capital. So which is an important part, the differentiation between donation or grants that you can typically get for a non-profit and impact investing for a for-profit enterprise is that impact investors typically are not donors, but they would want to get their investment back in some way. How that works, I'll share a little bit later, but that's just important to kind of like keep in mind that today's webinar focus is really more on the for-profit side than on the non-profit side. Why, in the end, you might want to ask yourself, would you actually want to go for the for-profit route and have kind of like a self-sustaining business model? Essentially for ideas on how that could look like. On the one hand, if it's self-sustaining, potentially you can build a bigger company out of that and therefore reach more people. Second part, in particular, it's more of a sustainable form where you can build kind of like a company long-term that is self-sustaining because you create revenues and therefore through those revenues can pay your staff, can pay your expenses, etc. The third part would then be very closely connected to that, that you no longer need to need so much time to raise donations or project funding because you have a self-sustaining model. And the fourth part that might be me being in Berlin, for example, which is obviously where a lot of startups compete with each other. I might also have a little bit of bias there, where salaries tend to get higher, in particular for technical solutions to social problems, for example, that if you are a self-sustaining a company that has, and can create their own revenues, you might be able to pay higher salaries and therefore potentially attract better employees. The kind of like when we now look at like the idea that if you were to go the route of a self-sustaining enterprise with a business model that is for profit, the main question, and that obviously for today's webinar also, is the question of like what type of financing instruments can actually be used, because typically we have maybe the startup world where we have a kind of an idea of like what financing looks like, and then we have the social enterprise world, and the question is, can those same financing instruments be used, or will it be different ones, and how do they actually differ? So I want to just share a brief overview of like how we actually define growth capital for social enterprises. Now here, what I want to show is that still going back to the differentiation between a non-profit or a for-profit, if you were to have a non-profit, you would be looking at kind of like the left column here. That is like non-repayable capital. That means like grants, for example, sponsoring, and you would do fundraising. Now, today's focus should be on the repayable capital part. The two main instruments that we most often see in the market is on the one hand debt, and on the other hand equity. There's a third one, which I will elaborate a little bit later on as well, which is called mezzanine. And it's kind of like a mix between debt and equity, so to say. Now, either way, no matter what kind of like instrument, first of all, you would be looking for, as long as you're not looking for grant funding, and as long as you're not looking for sponsoring, the repayable capital part means that you would have to look for investors. And investors can have different forms. I will elaborate more on that later on. But as soon as there's repayable capital involved, essentially it would be an investor that would expect that capital back, just that there will be different financing instruments for you for a social enterprise. Now, what types of financing instruments are out there? Essentially, I want to start with one that is kind of like typically one of the most well-known whenever we think of like investment, and that is typically equity. Now, what does that mean? Equity essentially means that an investor buys a part of your company, like shares of your company, and in exchange for money, for capital that you can then use for your company. So that's essentially a direct participation into your company. The advantage of equity in that regard is, for example, that unless like unlike a loan, where a loan or a debt you will have to pay back, you have to pay interest rates, and you need to pay back the loan, for example, after 3 or 5 or 10 years. When you raise equity as a company, you don't have to pay the investor back. That the mechanism is different because the mechanism here is essentially that the investor would want to sell their shares to someone else later on for a higher amount, and therefore recoup essentially the money that they invested. So that's essentially the idea for equity. Like an investor buys part of your company. With that money, you essentially try to like make your company grow, and later on that investor, for example, can sell the shares to someone else, or there's also an option, if your company is super profitable, you can maybe eventually even buy back the shares from the original investor. It has, however, especially for social enterprises, 2 challenges. One is, for social enterprises, typically exit paths are not as clear as for, let's say, a typical tech startup, where we think, I don't know, we build a new technology, and the technology might be interesting for another big company, and then that company buys your startup, and therefore the investors would, for example, get the money back. Now, for social enterprises, that might look slightly different, because it's not always clear to whom a social enterprise could be sold, or if it actually should be sold, because very often, obviously, social enterprises do not want to be sold because they want to solve their social problem that they're working on. So it's sometimes equity can be a bit challenging. What we typically in our work see very often when it is about social enterprises that, for example, build also a technological solution for a given social problem, or when it's anything that's kind of like is more related to climate tech, for example, that we could also still kind of like group together under social entrepreneurship, that it's easier for exit paths if it's like, you know, social problems that, you know, for example, working directly with people, essentially, it might be, you know, more limited exit paths, and equity might not be the right instrument for you. Also, one part about equity is always that there will be a valuation that needs to be agreed on for the company, and that's not always an easy part. It's actually, especially for early stage companies, rather tricky. Now, that is equity. So one instrument that is possible for social enterprises. The second part is essentially debt. Debt is what we would typically see as like a bank loan. That's kind of like the most common form of debt that we typically see, like whether it's like a bank loan, or also, for example, a loan from friends and family, or other interested parties that want you to succeed, for example. Now, a loan can be sometimes also a bit challenging, in particular when it comes to bank loans, because bank loans, for example, are very often tied to either it needs to have some sort of a security, so it needs to be a secured loan. That can be if you, for example, have assets, as in, for example, I don't know, you have like a house that can be secured, you know, for the loan. Or very often we unfortunately also see that there is a personal guarantee involved with the loans, so that you as a founder, as an owner of the company, would personally have to guarantee if the company cannot pay back the loan. A debt and loans in general are, however, repayable. So essentially you pay an interest rate, and then you need to pay back the capital that you got on top of that. So the challenge of that is typically it's very difficult, especially for early stage social enterprises, to actually get loans in the first place, because you don't have, like, you know, a strong equity base yet. The second challenge with loans is always that if you cannot pay back a loan, you are at a very high risk of then over-indebtedness, and therefore also at a high risk of insolvency if you cannot pay back a loan, which makes it typically rather an instrument for companies that are more mature than early stage. Yet it is a possibility, and we do see that in particular, for example, if it's founders that are okay with a personal guarantee, that they go that way of getting a loan, a particular bank loan, for the company. Now, those are kind of like two of the traditional or what we typically see traditional forms of financing. However, one of the actually most prominent forms that we see, in particular for social enterprises, is the third one, and that's what we call mezzanine. And mezzanine essentially kind of like, I put it in the middle because it's technically, if you look at it from accounting terms, for example, and from it's essentially kind of like a middle way. Now, mezzanine, one of the most prominent examples, like for example, would be if you were to do a crowdfunding campaign. A crowdfunding campaign for a social enterprise, in most of the cases, not in all, but in most of the cases, will be structured in the form of a subordinated loan. And a subordinated loan is essentially what is called mezzanine capital. That means it has, for example, the advantage that while being a loan, it typically does not need a personal guarantee or a secured loan. And at the same time, if you were as a company not able to pay back the loan, the subordinated loan, in time, you still do not risk insolvency, but the loan can actually be postponed essentially if you were unable to be paid back. And one of the other parts of it is that what we see often in social enterprises, that those kind of like subordinated loans or like mezzanine structures can also be tied to impact KPIs. And therefore, for example, interest rates can vary depending on whether you reach certain impact KPIs or not. Mezzanine, however, whether that's subordinated loans or different forms of mezzanine capital, are still repayable. Repayable essentially means that, again, you, for example, let's say you were to raise 200,000 euros from like a crowdfunding campaign. After 5 years, you most likely will have to pay back those 200,000 euros, and year after year, you will have to pay interest payments. The beauty of it is that it's, the exit essentially for the investors is possible via the cash flow, and the repayment can be structured very flexibly. So mezzanine capital is something that we see very often as a financing instrument for social enterprises, in particular early stage, but also like growth stage social enterprises. And we have seen that in, also in terms of like volume or size, like just in my recent work, I mean, I've seen anything from probably between 100,000 to like even, 5 to 10 million euros in mezzanine capital, depending on the maturity of the company. And the beauty of it is always that since it does not require kind of like this clear exit path, essentially it allows you to finance the company, like pre-finance the company growth, and then pay back the investors through your cash flow that you're generating later on in maybe year 3, year 4, year 5. Right. So that regard to financing instruments. If there's any questions on that, I'm happy to dive deeper into that in our Q&A session later. If not, there's also like a lot of information out there. You can, for example, go to the FASE homepage, but also other websites have good information on that. Right. Now, I want to speak a little bit about what types of investors are actually out there, because depending on the type of investor, they also typically then use different financing instruments. So I just put out a few kind of like different investors categories out there, and we'll elaborate a little bit more onto why I've structured them the way they are in this order. So we have something called business angels. We have what I mentioned already, crowdfunding platforms. We have social business angels that maybe look more on impact KPIs. There's foundations, family offices, social venture funds. But then also venture capital and banks. Now, why are they in that order, essentially? Two things. So on the one hand, the ones that you see more on the left side, so business angels, crowdfunding, social business angels, but also foundations and family offices, they typically invest their own money. And the ones on the right-hand side, so for example, venture capital fund or a social venture fund and also banks, they typically invest money of other people. So that means that the ones on the left typically are maybe a bit more flexible in terms of like how they would want to invest and how they would want to structure an investment. The one on the right, in particular, for example, if we look at like social venture funds or venture capital funds, they typically have a very fixed investment thesis on to what can they invest in. So they're not as flexible, they're more rigid. And the same with banks, for example, that they need certain requirements to be met in order to be able to invest. On the left, also very often what we do see is that it's, in particular when it's invested with like their own money, that's maybe a more of a long-term focus. And the way I've like set up that the order is also that those are typically more like impact first, whereas the ones on the right very often are more like finance first. Right, so maybe two quick remarks here, because like what most likely the most relevant ones for social enterprises would be on the one in social business angels, that is essentially business angels that invest their capital, but they want to invest into social enterprises. The same with like social venture funds. Social venture funds, like in Germany, there's a few bigger ones out there, for example, Ananda Impact Ventures, for example, is out there, and One Venture, for example. So those are like two of the big social venture funds that we see in Germany and other countries in Europe. For example, we have like Maze Impact or like Impact Ventures from Hungary. So there's quite a lot of them out there, and they are like, you know, quite interested in a pan-European pipeline. Venture capital funds, I think, is not so relevant for social enterprises, to be honest. Sometimes we see an overlap between like social venture funds and venture capital funds, but more when it's really about like technological innovation that has a very clear exit potential and can be like sold. Else, you know, it's very rare that we see like an overlap on those aspects. Now, so like those are all different investors, and I want to kind of like dive a little bit deeper into what are actually impact investors, because also the term impact investors is something that is very difficult to define, to be honest, because impact investors, a lot of investors call themselves impact investors, but they have like different strategies or like different, you know, focus areas on what they look at. And I want to start actually when I look at like the investor landscape with like the ones on the left and the ones on the right first. So on the left, excuse me, on the left I put like donors, and donors are typically actually not impact investors, even though sometimes they would consider themselves impact investors. Donors actually essentially do not expect their money back. So it's back to like the idea of like a non-profit social enterprise. You raise funding for like your project or like your social enterprise as a whole, but as a non-profit, you just work with that money, you like spend it for that social cause that is relevant for you, and your donor does not expect the money back. The goal for a donor is purely impact, and it's not any sort of like financial return. On the very right side, however, we see, for example, the exact opposite. That would be an investor that is like purely focused on like financial returns and not focused on impact at all. So they expect obviously their money back, and they expect market rate returns, whatever market rate returns in their specific asset class might mean. They do not have any impact goals. So those two are the ones that, you know, are out there, but I like don't want to like spend too much time on that. Let's rather focus on the three in the middle. Now we typically classify impact investors in three kind of like main categories. One is like impact only, the other one is impact first, and the third one is finance first. And essentially, like the way they differ is with regard to, on the one hand, their impact expectation and with regard to their financial return expectation. All of those investors, first of all, want to have their money back. So essentially, if they invest, let's say 100,000 euros, at the end, they also would like to see their 100,000 euros back. Where they differ, though, is how much money on top they would, for example, expect back. So we have like impact-only investors. So like they expect mainly that this money is like being, used for creating good impact. And next to their 100,000 euros, as in this example, next to the 100,000 euros that they invested, they would not expect any or maybe like very, very little return on top. That might be like maybe a 1 or 2% interest, or maybe a 3% interest. So essentially, money back is already good enough. The second category, like the impact first investors, they do expect some moderate returns. And moderate returns, what does that mean? That might mean, for example, if we look at a crowdfunding platform currently in Germany, at least, we see interest rates maybe about between 6 to 7 to 8%, maybe 5%, but that was probably maybe like a year or 2 years back. Now that interest rates in general have increased, it's probably somewhere between 6 and 8% per year that those impact first investors might expect back. So it's kind of like a moderate return. And the focus of the investment is still mainly impact. And then we have finance first investors. Now, finance first investors expect, on the one hand, their money back, and then they expect almost what we call market rate returns. And market rate returns is always a very difficult, very, very broad field, but typically on the venture capital field, they have the expectation very often that instead of like 100,000 euros, at least that investment would have the potential to maybe return them, I don't know, 500,000 or even like 1 million, like a 5x or a 10x amount, which seems quite high, which is possible for a lot of like technological innovations, but not so much for social enterprises, to be fair. Therefore, like finance-first investors would maybe not be the right fit for like a typical social enterprise. It might be a good fit, for example, for like a climate tech when it comes to like CO2 reduction or the like. So like those are different categories of investors. And I want to just kind of like point out here is that there are indeed investors for different types of social enterprises, depending on profitability level, depending on like how fast a social enterprise would want to grow or not. Generally, however, one thing that is, and sometimes even for us, obviously working in the sector, maybe a bit disappointing, is that most investors, even the ones that consider themselves impact investors, would be in the brackets of impact first and finance first. And about 85, so the latest kind of like studies that I've seen indicated that about 85% of impact investors actually do expect returns close to market rate returns. Now the question is always like, is that really then still impact if you expect kind of like the same amount of investment than if you were to invest in a purely financially driven technological company? That is to be discussed. I don't want to like go deeper into that today, but just be, I think my main message here should be there are investors out there that care a lot about impact and also care less about financial returns, but the majority of investors still do care a lot about financial returns while even also considering impact on top of that. Now, so much for impact investors. And I'm just looking at the time, so I'm about 30 minutes in. Which essentially means we can look a little bit more into how, for example, a fundraising process for a social enterprise would look like. And what I want to kind of like show you here is it's not an easy process, obviously, but it's doable. Doable with enough preparation. And four kind of like main points that I think are the most relevant. One is time. The second one is like the documents. Third one is strategic support. And the fourth one is mindset. Now, time, what does it mean? If you want to, as a social enterprise, if you want to get impact investors on board, be aware that it does take time. Not only the preparation phase takes time, but also, for example, all the meetings, all the calls, finding the right group of investors, finding enough investors to bring together. All of that does take time. So you should always start early enough, but with kind of like ideally a lot of proof of concept. So like if you can already show that your solution works, that you maybe have like the first customers, it's always easier than if you were to start directly from scratch, from zero, essentially. Then maybe an impact investor is not yet the right choice, but maybe rather like public funding sources or accelerator programs or the like. But once you have essentially like a good proof of concept, then that does definitely help and also accelerates the time of the funding. Now, in terms of documents, when you start to reach out to impact investors, there's a few things that you typically need. One, you need to have like a good idea about your finances and kind of like have a financial plan, essentially how much money you want to raise and why you want to raise that amount of money. In the financial plan, that's typically detailed of like, for example, what's your hiring plan? What are your revenue goals? What are like your cost structures like? So all that does help. The better you prepare your documents, the easier it is in the end to also persuade investors to invest into your company. The second one, and I think that's also quite standard, is a pitch deck. And what we very often see also, what does help is if you have maybe like a 1-page or a 2-pager that kind of like you can just send quickly to potentially interested investors, like an investment profile. In particular, when it comes to crowdfunding platforms, videos are quite the standard as well to have in particular more of an emotional message. And that's quite important also for social enterprises where It's not only about like a pitch deck and the right numbers, but it's also like the emotional message that is connected to that, and the video can show that quite well. If you have to kind of like pick and choose, the first two, like the financial plan and the pitch deck, are typically the most important ones. The other ones can help in the process. Now, the third part would be strategic support. We would always recommend, number one, get a good lawyer. Despite lawyers obviously being expensive, it is quite important, in particular when it comes to signing investment contracts. Better pay maybe the lawyer in the beginning, rather than have to pay a lawyer afterwards if like there were things in the investment contracts that you were not aware of. So a lawyer, having a good lawyer is a good help in that process. And at least equally as important, make use of the experience of others. That can be, for example, other social entrepreneurs, other entrepreneurs who have been through a fundraising process, who can kind of like, give you advice and hints on what's important and whatnot. Obviously, you can also hire external firms, but oftentimes you can really just also make use of the expertise of other founders. And the fourth point, and that is not to be underestimated, is kind of like the mindset part. On the one hand, to kind of like be able to accept changes. And I mean, we at FASE, obviously, we do this work as a living. That is our job, to structure financial, fundraising processes and structure finances for social enterprises. But what we do see, and typically maybe a fundraising process, if it takes 6 months, and 6 months can be quite a lot of time for a young company. So like, things can change, strategy can change. So you got to stay flexible in a way, and customers can change. So it's quite important to then also not forget about the core business, because fundraising, it takes a lot of time. It's sometimes founders always tell me it's kind of like a full-time job next to the full-time job of a founder. So be prepared for that, and don't forget about the core business, because that's always closely related, obviously, to the success of a fundraising round. How would like such a process look like if we look at it kind of like on a time frame? I already indicated, like typically what we see is 6 months is kind of like a good time from like, you start to prepare your documents, get everything together, you write your pitch deck, write your financial plan, until, for example, getting the money onto your account. We very often, not only social enterprises, but founders from startups in general, do believe it goes faster, because there's obviously companies that can do it faster. And we've also seen rounds being closed in 3 months, in 4 months, but those are typically the exception rather than the norm. So to be on the safe side for you as founders, always try to, I mean, we typically obviously expect founders to like be very much convinced by themselves, because that's kind of like important for running a company. But at the same time, also be humble in a way of being like, just because like maybe 5% of the companies manage to raise a round in 3 months, 95% still don't. So better plan more time and plan accordingly with regard to your cash flow and your finances, so that you can, for example, or you start early enough that you're not out of money 2 months down the time when you're still in the fundraising process. Because what then happens if you're like out of money is typically it's more difficult to raise, and also like you have less leverage against investors when it comes to interest rates, all of the evaluations or the like. So typically, long story short, about 6 months time is what we recommend you to kind of like plan for. Start ideally with like, the preparation of the financial plan and the calculation of the investment sum. That means think, well, okay, what is it actually that you want to achieve in the next 2 years? What are the resources that you need for that? Whether that is, for example, new positions to be created, like people to be hired, marketing activities that are needed, and all this essentially will determine like the amount of money that you will have to spend in order to achieve a certain goal, which should be the goal for like a fundraising round. And then you have like a certain number, and that can be maybe 200,000, 500,000, maybe 5 million euros. And then essentially you have kind of like a baseline. We sometimes, and it's typically maybe not a bad idea, see that there might be different scenarios. For example, if you can raise 300,000, you would do that. If you can raise 600,000, you can maybe do a little bit more. So that obviously does help to have kind of like this always in the back of your mind. But you should always just, when you start raising, go out with one plan, and then if you have to, adjust to another one, but don't, you know, just go out with 3 different plans, because then the investors don't know what they would be looking at. So once you know, however, how much you should or you would like to raise, then you can, you know, continue preparing your pitch deck. Typically, in the pitch deck, I mean, that's a whole chapter by itself, but it should be, you know, ideally maybe like 15 pages, you know, if you're like early stage. Later on, it's always better to have a read deck that is maybe like a little bit longer, maybe 25 pages or so, that, you know, has more information, but in the beginning, shorter is also fine. And there's good resources out there in the internet on how a good pitch deck structure can look like. So feel free to like search around, and there's a lot of like good examples and resources out there. So once you have done that, it's about identifying who are actually your potential investors. Important always to understand what category of investors you would be looking at, whether that's, for example, you know, social business angels, or is it social venture capital funds, or is it foundations or family offices, because all of them have typically different amounts that they invest, but they have also, you know, different requirements. So like venture capital funds or social venture funds invest typically later stage, once there's already like, you know, first revenues. Business angels might invest only in a team, in an idea, for example. So it differs, right? So important for you to understand what type of investor you would actually be looking for. And then, for example, let's say if you were to, like, let's say you build a financial plan, and in the financial plan it says you need 1 million euros, but you don't really have a product yet, for example. That might be, for example, challenging, because of 1 million euros, it would be then maybe the right size for a social venture fund, but they would require that you have already a working product. For angels, it might be maybe the right stage, but it's difficult to get 1 million euros from angel investors. So it's quite important to kind of like understand, well, what are typical ticket sizes for investors? How many investors would I need to bring together? And where do I stand in terms of like my product development, my revenues, to really find the right match between, you know, where do I stand as a social enterprise and what type of investors will be relevant for me. But now imagine you identified your investors, you sent out your pitch deck, and the investors come back to you and say like, hey, you have a great idea, you have a great social enterprise, let's talk. So that's typically then when the real process starts. In the end, is kind of like the process of like one call after another. Typically, it is, you know, we've seen things from social business angels that have one call and it's enough for them to take a decision, and then they write a check. For other angels, and also in particular for social venture capital funds, that means maybe 3, 4, 5 conversations in order to come to a conclusion. And that is then part of the due diligence process, where it's really about, for example, one call specifically to finances, one call specifically to your market approach, your sales strategy. So be prepared for a lot of like, you know, questioning. The good thing is, however, something what we would always recommend as a best practice is to pay very close attention to the questions that investors ask, and kind of like, you know, accumulate kind of like such as like a Q&A sheet, because a lot of those questions will repeat itself from different investors. And that can mean 2 things, essentially. One is that maybe in your pitch deck or in your pitch itself, you might not have elaborated it well enough. So that's why the question always comes over again. Or maybe it's just something that is, and maybe you might want to create an additional slide in your pitch deck for that. Or maybe it's just something that you want them to ask, and therefore, you know, you're prepared, and then you can, once you have like your Q&A document ready, you can always pick and choose, copy and paste from the answers, and then easily, you know, feed these information to the investors. So once, like, imagine now you have a group of investors that, you know, have been through the due diligence phase, and they seem very interested and they want to invest. And that's typically negotiation phase. So, for example, okay, how much money do you really need? What's the valuation, or what should be the interest rates if it's a mezzanine, a subordinated loan, for example. And then typically what we see is then what we call a term sheet. In this term sheet, that can be a between 2 to 20-page document where the main terms of like the transaction would be disclosed. For example, social enterprise A wants to raise 200,000 euros and at an interest rate of 7% for a loan duration of 5 years. That would be, for example, something that's in the term sheet. And then, for example, different clauses about how kind of, for example, what kind of like decisions need to be approved by like a board of investors, like the owners of the company, etc. So that can be, you know, quite a slim document, but it can be also a more extensive document. And once that is agreed upon, that's typically something that the lawyers of like each party do with each other. Then it's about signing a contract. It will be kind of like transferred and translated into an investment document. And then that will be signed, and then typically shortly after the funds will be dispersed, and then the fundraising process would be ending there. However, you will have other requirements afterwards, typically, that are reporting requirements of how you spend the money, for example. That can be a quarterly reporting or a yearly reporting. Some to even do like a quick monthly reporting, just like in an email. But that is like kind of like afterwards, once you have an investor on board. Right, now, so that has been an overview of the investment process, and we are now at about 45 minutes in. That would be essentially all the content that I have prepared for you for today, and I hope that has been helpful. I see there's one question in the chat. That is cost for such a consultancy in a fundraising process for FASE. Is it a fixed sum or performance rate? So typically FASE, the way we work is we work with a success fee and a monthly retainer. That's why we typically don't work with like very early stage social enterprises, because that's just difficult to finance if you don't have revenues yet. But if you have revenues already, and you know, typically we work with companies that raise between like 1 and 5 million euros. It would be a rather slim monthly retainer, and then a success fee on the amount of capital that we mobilize for you through our investor network.